Hi, I'm Candis Fitch, Portfolio Manager at IAIC, and welcome to another episode of In Focus. Today, I'm joined by fellow Portfolio Manager Nick Leach, who is responsible for the income producing portion of our portfolios. Happy to have you back on the podcast, Nick.
Good to be here, Candice.
Just as a quick reminder for our folks listening, our income producing sector includes bonds, preferred shares, and income trust units. But today we're going to focus on the bonds, especially in the wake of some regional bank failures in the US. Can you give us some context on how that impacted our Canadian bond market?
Yeah, there has been some excitement. In March, we saw government bond yields drop um, by about 80 basis points. That's the 5-year Canada bond yield dropping that much. It dropped in the US as well. 80 basis points might not seem like that much on the surface, but on a relative basis, the starting point was 340 basis points. So yeah, it was a material move. And yeah, Candice, it's those couple of regional bank failures that contributed to that drop. Those failures stirred fears of a spreading banking crisis. So we saw investors fleeing to the safety of government bonds. But on top of that, it wasn't just that flight to safety. We also saw central banks becoming less hawkish on lower inflation numbers. So the Bank of Canada did not raise rates at its meeting for the first time in over a year. And then we also saw the Federal Reserve at their meeting. They kind of opened up the door to a pause. So yeah, two drivers for those falling yields. But it's really hard to disentangle those two drivers over the course of a month.
Right. And when we think about 80 basis points, it doesn't seem like a lot, but in the bond world, that's a
Yeah,
lot of excitement.
yeah. When rates are around 3.5%, it's like a quarter of the yield that moved.
Right. So, let's chat a little bit then about the opportunities in the bond market. And can you touch on corporate credit spreads and current yields?
Yeah, so corporate spreads, they also spiked in Canada by as much as 30 basis points. Again, 30 basis points on a relative basis for spreads, that's also a big move. And that was clearly driven by those US bank failures and the fears of contagion. But then on top of that, shortly after, we had the failure of Credit Suisse. So there's AT1 capital bondholders for Credit Suisse completely wiped out. So that led to concerns in Canada with the limited recourse capital notes that are issued by our banks. And that caused a significant sell-off in that market. And that sell-off actually prompted the Bank of Canada to take steps to ease those concerns. So they released a press release to remind investors that LRCN bonds in Canada have a really different structure than the AT1 bonds in Switzerland. So what happened in Switzerland won't happen in Canada. So that eased some concerns. Credit spreads did slowly start to tighten since then as those banking concerns kind of wane, but they still remain elevated. So where does that leave us in terms of corporate yields? So you had that drop in the yields on government bonds, and that was partially offset by the increase in yields due to the higher credit spreads. So right now, when you look at our 1 to 5 year corporate ladder, we're averaging around 4.75, and it's been around 4.75. Let's say plus or minus 25 basis points for the last several months. So it has been relatively stable.
Right. So, when we're talking about the bond world, we like the word stable. Unfortunately, there's been some other exciting news in the bond world. We've heard a lot about the term inverted yield curve in the news. Can you explain to our listeners what that is and what it means for IAIC's bond strategy?
Yeah, so inverted yield curve is pretty simple. You have short-term interest rates that are higher than medium or long-term interest rates, as opposed to a normal yield curve where you should have short-term interest rates lower than longer-term interest rates. So basically, that's the bond market. So the bond market, and this is both in Canada and the US. So the bond market is expecting the central banks to lower their short-term overnight policy rates either later this year or sometime in early 2024, right? So if they're going to lower rates, you have to ask, why would they do that? One, clearly would be to fight a recession, or two, to fight deflation. We were having fears of deflation prior to COVID. Or both, right? So that's a tough call. But fortunately, our strategy has never been to speculate on where interest rates will end up. You could have all sorts of exogenous, unpredictable events that could drive rates up or down, and we have seen that recently. So our focus is on corporate credit, credit quality, and the extra yield that we pick up when we invest in corporate bonds. So one thing we do know, or that we can forecast with a very high degree of certainty, is that the high quality bonds that we're buying today, whether they're 1, 3, or 5 years, they're going to be earning almost 5% annually, whether there's a recession or not. As long as we hold those bonds to maturity, because the corporates that we invest in, they've proven themselves to withstand recessions, right? They're either very stable defensive businesses, or even those businesses that do have some cyclicality, they have bulletproof balance sheets. So those balance sheets kind of insulate the bondholders from any earnings volatility. Right. And then maybe lastly, the bonds that we're buying today, they are at a discount. So part of that yield to maturity is a capital gain. So they're far more tax efficient, safe than GICs.
Right, which we love that when we're talking about tax efficient investing. Well, thanks so much, Nick, for your time today. As always, if there are any questions about what you heard today or your portfolio in general, please don't hesitate to reach out to your accountant, advisor, or financial planner or portfolio manager.